we can start the discussion. In fact, last week there were a few technical setbacks in terms of online access for the class, where a few times the connection was broken down for some reasons of technicalities, but I'll try to kind of take very briefly few points I was discussing there, but more or less we started discussing the expectation hypothesis of term structure of interest rate. We discussed the so-called risk structure, but then we move on to discuss about the term structure of interest rates, and there we highlighted the element where three particular theories which tries to explain you all why yield curves take different shapes, and they were trying to explain three factors, and they wanted to identify why bonds of different maturities. When I say bonds of different maturities, here we are taking same default probabilities, right? Same tax treatment. Therefore, what differs here is the maturity, time to maturity. Okay, liquidity default probability, and tax consideration are same here, but maturities are different. So we are looking at the possibility that the different maturities over time move together. If the short-term interest rate increase, medium to long-term interest rates also increase. If the short-term interest rate decrease, medium to long-term interest rates also decrease. May not necessarily by the same amount, but may have some difference in terms of magnitude of the change. Okay, so that's one element. Another element this term structure theories tries to explain is when short-term interest rates are low, yield curves are upward sloping. That means long-term interest rates are high. At times of short-term interest rates are high, okay, yield curves are downward sloping, where long-term interest rates are low. Downward sloping is, in other words, you call it inverted. And then a third point they try to explain through these theories is that mostly yield curves are upward sloping. Okay, so the elements of these theories try to explain these facts that any person is interested in. And three theories: one is expectation hypothesis or expectation theory, then the second one is segmented market, okay, and the third one is liquidity premium. You can again combine this liquidity premium with another theory called segmented market extension, that is so-called preferred habitat. We will see those details as we move on. We discuss about this chart also. We discussed this and explained to the extent where we were highlighting the factor at different points of time: upward sloping yield curves, flat yield curves, downward sloping yield curve, all visible through this time series behavior of US treasury papers, treasury bills and treasury bonds of short-term to long-term maturities. Okay, there's no difference if you look at Sri Lanka's treasury securities interest rates behavior also. Maybe the levels are different. So that's something you have to factor in. But we moved on and we came to discuss about the expectation theory. This is where we had some technical setbacks. Before I move on, you have any queries for me to stop here and take any questions that you have before I move on and explain the elements of these three theories? right? I'll take it, or you can drop a small message in the chat section so I can also follow up. But it's interestingly, please remember the risk structure and term structure, where the term structure, as you already know, look at same identities, default, liquidity, tax, but different maturities. Okay, but risk structure look at same maturities, but different identities. We looked at, and then we discussed about this credit rating structure, all kind of things there. But the expectation theory of risk structure analysis, term structure analysis, okay, is very, very important theory, which explains that interest rates of a long-term bond is nothing but, please understand, long-term bonds interest rate is nothing but an average of short-term interest rate that will occur throughout the lifetime of this long-term bond. So if you look at a, let's say, 5-year bond, that is a long term for you from today. So that 5-year bond's today's interest rate is nothing but the average of, let's say, 1-year interest rates that will occur across 5 single 1-year periods. First year, 1 year. You go to second year, another 1 year. You go to third year, another 1 year. Fourth year, fifth year, the 1-year interest rate. So you divide that by 5. Okay, then that should be equal to today's 5-year interest rates. So you expect future short-term interest rates to increase. Today's 5-year interest rate also has to show a higher level than today's 1-year interest rate. It is like this. You will get into the example. It will be very clear, very easy for you. But heads up, let's look at today's 2-year interest rate. Okay. So today's 2-year interest rate should be equal to today's 1-year interest rate plus 1-year interest rate 1 year from today, both 1-year interest rates now you have, divided by 2. So today's 1-year interest rate, assume 5%. Next year's 1-year interest rate, assume 7%. So 5 plus 7 is 12 divided by 2. That means 6. So today's 2-year interest rate should be 6%. Then only you will invest in today's 2-year papers, 2-year bonds. And another interesting factor that the expectation theory explains to you is that bonds are perfect substitutes, because 1-year interest rate and 5-year interest rates that you are seeing is, in essence, has to give you today's 5-year interest rate has to have equality in terms of 1-year interest rate occurs throughout the life of this 5-year interest rate. So you find these elements weight each other. At any moment of time, if the market see an opportunity that the 5-year interest rates are higher than the average of 1-year interest rates happen throughout this 5-year, you tend to demand 5-year. So then the 5-year, what happened? Higher the demand, right? Prices increase. That means interest rate decrease. So then it's again matches. any arbitrage excess being cleared out by the market by this behavior. So this is the essence of expectation theory. Very simply, a long-term interest rate are nothing but the average of short-term interest rate that people expect to occur over the life of the long-term bond is the expectation theory. Okay, so then you see here the example that I was discussing. So again, we can refresh ourselves to say that you assume that 1 year interest rate today is 6%. And you also expect 1 year bond interest rates to be 8% next year. Today's 1 year is 6%. 1 year from now, 1 year interest rate is 8%. Then the expected return of buying a 2-year bond today is nothing but the average 6 plus 8. That is 14 divided by 2. That is 7. So the interest rate on a 2-year bond must be 7% for you to willing to purchase it. If it is higher than 7%, even the 1 year buyers will jump to this 2-year paper. And as a result, the higher 2-year interest rate would fall down, come back to 7% or anywhere. So if it is less than 7%, you will not prefer this 2-year bond. You will go and buy 1 year bond. As a result, 1 year interest rate would decrease because price will increase, more demand for 1 year. So that's the adjustment market will do, right? So we are putting this into equation. Okay. You can have this equation well explained in terms of these notations and things like this, but keep that basic understanding. You have to get that basic understanding into your head. Just assume IT. IT is, I is interest rate, T is time. Today's interest rates on a 1 period bond. IT is today's 1 period bond. IE, I expected, T plus 1, 1 period from now. T is today's 1 period. T plus 1 is, just say tomorrow's, or 1 period from now, expected 1 year interest rate. So I2T is today's 2-year interest rates. So these are notations you can read through. But establishing the equation, what you are basically seeing is expected return over 2 period bond from investing $1 in the 2 period bond and holding it for 2 periods. 1 plus I2T, that is interest rates of 2 period bond, times I plus I2T, again the next year's 2 years interest rates, because if it is a 2-year bond, first year you get the interest, second year you get the interest, minus 1 the original investment. You take out the original investments. We are looking at the return. So when you simplify this, you multiply 1 by 1, it's 1. Then you multiply 1 by I2T, then 2IT, 2I2T. Then you see the same thing being multiplied, its power term comes, the same being deducted. So this is simple simplification of the equation, right? So effectively, what you are basically seeing in this equation is, it is the return of two periods of I2T. I2T is today's 2-year interest rate. And you get this today's 2-year interest rate 2 times if you invest for 2 years. Plus I2T to power 2, this is the reinvestment of interest on interest. Okay. So, but this element is very small, very small. So you can, in principle, keep that away from the discussion for the time being. Okay. We will get that as we move on. Effectively, what you are basically seeing is the expected return for the holding of 2-period bond for 2 period is nothing but 2 times of I2T. I2T here is today's interest rates on 2-period bond. So that is the equation. But then that is a 2-year investments you looked at. Today you are investing for 2 years. But if you are investing today a 1 period, that is IT, interest rates of today 1 period is IT, times what you are getting here is next periods, T plus 1's 1 year interest rate. That is expected 1 year interest rate 1 year from now. So again, you simplify this 1 by 1, 1 by this, IT by 1, IT by IET plus 1. This is a simplification. See, you see here, right? So this is simplifying the equation. And again, this element in the 1 year investment and repeating next year again for 1 year investment is very small. So what you are basically seeing here is in the 2 year you saw 2 times I2T, where for 1 year what you are seeing here is IT plus I expected T plus 1. 1 year this period interest rate plus 1 year expected in the next period interest rate. So this is the investment return of 1 year cycle. We are just keeping this out, this element, the very small element that is interest on interest aspect, for us to understand this easily. So in the expectation theory, what you are simply saying is long-term interest rate is nothing but the average of short-term interest rates that occur. But now you see, when you look at this 2-year interest rate and 2 1-year interest rates that occur in this 2-year period, if you write down the equations, 2I2T equals IT plus IET plus 1. So simplifying this equation, you see here I2T is nothing but, if you take this simplification further, take this 2 to the other side, it becomes division. This is multiplication here, it's become division. What this again says is 2 period interest rate is nothing but the 1 period interest rate plus 1 period interest rate occurs next period and divided by 2. It is the average. If this is 5, this is 6, 5 plus 6 is 11, 11 divided by 2 is 5.5. Then I2T has to be 5.5 in today's angle. And we looked at 2 periods. But in markets, it could be any periods. So that for simplification, you give N for number of years. For the N period is nothing but, today you are investing N period, let's say 10 years, let's say 20 years. So I20T, if N is 20, I20 years interest rate, today's 20-year interest rate has to be 1 year interest rate today, 1 year interest rate next year, 1 year interest rate 2 years from today. Likewise, you go on and you finally find 1 year interest rate on the 19th year. 20 minus 1 to N is 20, right? So it is 19th year. So you take all this, and here you will get 20 N. So 1 year today, 1 year next year, 1 year second year, plus 1 year 19th year divided by 20 should be equal to today's 20-year interest rates. So if the markets are in expectation theory, balances out your expectation, where you buy a long-term bond today by expecting a short-term interest rates that will occur from today to the long term that you are investing, and get a kind of a view in terms of its average. So if the average satisfies you, you will investing long term. If you see average is different, makes the difference in terms of either it's a higher level or low level, you will shift your preference from long term to short term. As a result, any arbitrage exist in the market would clear off. Okay, so this is what the market does in terms of expectation theory, right? So this explains, as we discuss in terms of 3 elements that the theories try to understand, to the effect that different interest rates, if short-term interest rates changes today, you expect short-term interest rates that's happening across the period from now also to adjust. So your long-term interest rates also adjust. Increase, it also increase. Maybe not the same magnitude, but different magnitude. But it tells you if it is increasing, it's increasing, both short end and the long end. And similarly, decreasing, it tend to decrease. So the move together, interest rates over time moves together, is explained in this argument. And the other element, when the short-term interest rates are low, you expect future interest rates to be higher. Because next year's shorter interest rates also, you expect, let's say, it's still low. But the following year, it could revert back to a level maybe higher than what you say low now. Why you say low? You experience that previously it was higher. That's why you say low. Otherwise, you will not say low. And the other thing is, from inflation also, you can explain the second point. Central banks keep interest rates low when they see inflation expectations are well anchored, or they want to energize the economies. That means economic activities to expand by making investable funds cost low. Okay, so you see, interest rates being low means you encourage more investments, through which you encourage more economic activities to happen. As a result, the economy's income increases in the period ahead, coming periods. So that would push prices to go up a bit, because demand goes up when your income increases. We discussed about wealth and all kind of things in our previous lectures. So as the inflation tend to go up, central bank increases the short-term interest rates to manage inflation again. So that itself says, when the short-term interest rates are low, long-term interest rates are high. That means yield curves are upward sloping. When short-term interest rates are high, means central bank is fighting inflation, so future inflations would come down. You know, Fisher equation, real interest rates, argument, all kind of things. Then what happened there is, When the short-term interest rates are high, long-term interest rates tend to be low. So it's a downward sloping, if not inverted yield curve. So that explains the second factor also. But the expectation theory does not necessarily try to find the explanation that yield curves usually slope upward. But you remember, there is an element called small, and we kept it out from the equation. That to some extent explained here. But we will not confuse ourselves with that for the time being. If you are so keen to study that, right, you can follow further studies, or you can read some of my research papers published in journals. You can Google in my name, you will find some of those publications. So it's there, right? You can figure it out. There's an element of upward sloping expectation hypothesis driven interest rate structures. That's a different element. But what I'm simply keeping here is just accept the fact that that small element doesn't play a role. So it's difficult to explain why it usually slope upward. We will explain that through other theories that we are going to study. Let's come to segmented markets. Any questions before that? Because this area is very interesting. If you have a little preference, you will definitely study this very seriously. But what I'm simply telling is these are very important aspects that explains why interest rates takes different shapes. Why yield curves, today's 1-year interest rate to 5-year interest rates to 20-year interest rates, why they take different shapes. And that explains underneath economic expectations in any economy. Pessimism, optimism, not at all worried about what's happening elsewhere, all explained behind these movements. Right? So it's not one party or two parties behave, it's the billions of rational people's expectations. So if you pool them together, you can make some assumption where the economies are heading, economic activities are heading. That's what we are trying to inculcate in you all through this type of courses. You try to get this understanding and interpret yourself to read, understand, not only answering your exam papers. Exam papers is very good for the time being, but make use of this knowledge to enhance your understanding about what's and how financial markets behave. And try to explain, you try to understand in the first place. And you feel you wanted to raise any question, please feel free to raise it. If not, you can put it in the chat form and we will try to understand it. So we'll look at the segmented market theory, second theory of this term structure of interest rate explanation. Right. So in the expectation theory, we said interest rates are substitutes. Okay? You are indifferent. In expectation theory, you are indifferent whether to buy a short term or whether to buy a long term. Because you know long-term interest rates are an average of short-term interest rates that will occur throughout the life of this long-term bond. So you are indifferent there. So you can substitute. But segmented market says different maturities bonds are no substitutes. markets are segmented. One segment, the other segment, another segment, it's there. Short-term market is full of short-term bond buyers and sellers. Long-term bond market is full of long-term bond buyers and sellers. So the interest rates in these different segmented markets are determined through the interaction of buyers and sellers, demanders and suppliers of that category. And you probably see from a very general perspective, pension funds, insurance funds in any market would prefer long-term bonds. Why? Simply because their liabilities are long-term in nature. So they want to match their liabilities, long-term liabilities, with long-term investments through which they take out the market risk in their investment portfolio. Market risk is the volatility of interest rate. So if you invest today for 5 years, you are reasonably taking out the 5-year interest rate volatility because you invest and hold till 5 years. So your return is yield to maturity. Similarly, you see all these not mutual funds, money market funds, part of commercial banks' funds that they wanted to invest in short term, are the key players in short term market. So the market is generally crowded with these short term investors. So the short term market interest rate is determined by the behavior of these short term market buyers and sellers, suppliers and demanders. Okay. So naturally, in a segmented market explanation, investors have preferences. I said pension funds, insurance funds, they have preferences. They have long term in their mind. Money market funds, they are interested, preferred the short term bonds. Okay, then you have saving funds and things like that. They prefer medium term bonds. So these maturity preferences makes one market separated to the other. So they are the players in the market and they drive the interest rates according to the demand and supply forces in that market. But I said generally the short-term market is crowded. Many people are there. Even long-term investors, when they don't see a long-term investments, they will wait till they get a long-term, so invest in short-term. And the other element is the investors generally prefer short maturities, short-term market that have less interest rate risk. You see, the uncertainty is low in short term compared to uncertainty for long term. So you are pretty certain what could happen to you tomorrow, next week. You have a reasonable picture. Still it's uncertain. Anything could happen. But it's reasonably certain compared to 2 years from now, what will happen to you? What will happen to the environment? So the uncertainty is less in short term. interest rate uncertainty also less in short term. You are reasonably sure where the central bank interest rates in the short run. It's today's interest rate tend to be a direction for tomorrow's. But you are not sure what the central banks would think 1 year from now, 2 years from now, where the short-term interest rates would be. So the investors generally prefer, as I was said, short-term investments, and generally short-term market is crowded. That means the demand is high in the short-term market. When the demanders are more and high in the short-term market, what happened to the price? Price is high. Higher the price, lower the interest rates. When the interest rates are lower for short term, what it indirectly means, the long-term interest rates are higher than short-term interest rates. So you draw a line and connecting these points short term to long term, the yield curve is upward sloping. So the segmented market theory is the markets are segmented. The demanders and suppliers of those markets determine the yields of long-term, short-term, medium-term interest rates. Okay, and the bonds are not necessarily substitutes. They have preferences of one maturity over the other. And you know now, short-term market is crowded because less interest rate risk in terms of uncertainty. Then the short-term interest rates tend to be lower. When the short-term interest rates tend to be lower, long-term interest rates tend to be higher. As a result, yield curves slope upward. So one of the factors we are looking in explaining the yield curve's behavior is explained by the segmented market theory. And the segmented market theory explains the third fact, that is, usually yield curves are upward sloping. Any questions? Then we see liquidity premium. Third and the most sought after in today's context in explaining the behavior of interest rates of different maturities but identical terms and conditions. So the term structure explanation is explained by so-called liquidity premium and effectively preferred habitat theories. Preferred habitat. Habitat is your preferred zone of living. Even in jungles, you see, the animals have their preferred habitats. Some animals live in certain parts of the jungle where they have access to water, access to grass, where in some other habitats where long, big, tall trees exist, a different type of animals live. And in some other places, you find the animals who eat meat, they live. They crisscross the grassy lands and open fields where they can have their food. So they have their habitats. And even in your residence, in your home, you have your preferred habitat, right? So you used to that. Right? So that's where you stay and do most of your activities. So your parents, to get you out of your preferred habitat, to get you to the veranda or to the living room or for a discussion, probably entice you by giving a carrot. Sometimes a treat, sometimes some other things. So you move out from your habitat. It's same, jungles, residents, everywhere it's same. It's the behavior. So in the market also, what this liquidity premium and preferred habitat tries to say is the bonds of different maturities are not perfect substitutes. You can't look at 1 year versus long tenor, short tenor versus long tenor. There are people in the short tenor market, they prefer short tenor bonds. There are people in long tenor markets, right? Like pension insurance funds, they are in the long tenor market. But to get these short tenor market people, long tenor market, you have to entice them. You have to give them a carrot. So they say these are partial substitutes. Still, you can get them to invest. Still, you can ask them to move out from their preferred habitat. That's the short-term market. And look at long-term investment. But to get them to move out, you have to give them something. So what the liquidity premium and preferred habitat tries to do is the interest rates on a long-term bond will equal an average of short-term interest rate expected to occur over the life of the long-term bond. What is this? What is this statement? You see, this is nothing but the expectation hypothesis explanation of interest rate plus a liquidity premium. That is the carrot. That is the additional incentive you give these different market peoples to move out from their preferred market, preferred habitat, and go to the other market and invest. That is the liquidity premium. And that decides based on supply and demand condition in that market. And that's what the liquidity premium and preferred habitat theories say. It is nothing but expectation hypothesis plus a liquidity premium. As a result, you can still entice these participants to come out from their preferred zones to invest in the other zone. So when you look at this, look at this equation. This first part is nothing but the expectation theory's equation, n-1. Except this plus LNT. This LNT is the liquidity premium and it is always positive. Longer the maturity, LNT, liquidity premium, is higher because this LNT increases with term to maturity. As long as the uncertainty is big, you have to give them additional premium. Higher the uncertainty, additional incentive. Lower the uncertainty, lower additional premium. So this LNT increases with the time to maturity. So what this explains is, this component already explained you the first two elements. We explained that under expectation theory. This LNT component would also explain the fact that usually say shape upward. Usually yield curves shape upward means long-term interest rates are higher than short-term interest rates. When LNT is positive and this positive number increases with the tenor increasing. So if it is 0.25, 0.5, 0.75, 1%, as you move on, it increases. So it's upward sloping. So the liquidity premium or the preferred habitat combined explains all three facts that you wanted to know about term structures. It's moved together in normal circumstances. It takes upward slope when short-term interest rates are low, when it takes downward, if not inverted shape, when short-term interest rates are high, and generally it shapes upward slope under normal circumstances. It's all explained here in liquidity premium theory. Okay, so slight specific factors in liquidity in the preferred habitat theory. Liquidity premium and preferred habitat jointly bring in that LNT into the equation. But preferred habitat, as I said, has expansion in terms of, yes, investors have preferences, short-term investors and long-term investors. They have preferences. They have their demand and supply in their markets, like segmented market. It's not something we have to dismiss. It is there. It is actually a fact. Investors prefer their preferred maturity zone. They act in that maturity zone. But still, they will be willing to buy bonds of different maturities only if they earn a somewhat higher expected return. That is the carrot incentive to get you out from your preferred habitat, from your room. Right? So see, this preferred habitat explains the fact that you have to entice the participants by giving them some additional, somewhat higher expected return. And then generally investors likely prefer short-term bonds over long-term bonds because of uncertainty, interest rate risk. We explained that. So when that's the case, short-term interest rates tend to be lower than long-term interest rates because more people are in short-term, higher demand. Higher demand means higher prices. Higher prices mean lower interest rates. So you can see here the explanation of preferred habitat very clearly to support all three facts that we were trying to understand from this term structure of interest rates. So that explains the behavior of yield curves, behavior of different maturities but identical characteristics, bonds, why their interest rates are different, why the yield curves take different shapes, what it entails, what it explains, all here. So if you can get this into your applications, you are very much better off in terms of how to analyze different shapes of yield structures. Right. Any questions? Okay, so we'll move to the next slide, which actually plots this. What it basically brings in is the element of expectation theory driven yield curve that generally tend to be closer to flat, simply because you see you are indifferent between maturities. The long-term interest rates are nothing but the average of short-term interest rates that will occur across, if not throughout, the life of long-term interest rate. So it is indifferent. But if you see, if the short-term interest rates are increasing, you naturally see long-term interest rates also higher. If short-term interest rates are decreasing, you expect long-term interest rates also to be lower. So that would explain to some extent under expectation theory, the movement of interest rates, they move together and then has a general upward slope or downward slope. But liquidity premium or preferred habitat, on top of this explanation, add this LNT component. That is the liquidity premium component. And you know, longer the maturity, higher the liquidity premium, driven by uncertainty. So what you basically see is the yield curve tend to slope upward also in such circumstances. But this does not mean that the yield curves are always taking a one shape. Generally, it's upward sloping, but still there could be circumstances where the yield curves are downward sloping if expectation that future short-term interest rates are lower. So the average of future short-term interest rates would define today's long-term interest rate. So the effective number you will get is lower, and even after compensating for liquidity premium, it would still look lower than short-term interest rate. So then it's a downward sloping. And that type of explanation would very clearly say the future economic activities is very bleak. And that's what empirical studies also explains. And if US, where you see generally information asymmetry is low and markets represent information efficiency, even in OECD countries, what you are basically seeing there is if the yield curves tend to get inverted, they expect economy to go on a recession 2 quarters down the line. That means 6 months from now, they expect economy to go into recession, negative economic growth. This is empirical studies. Lot of information, interest rates behavior across longer time periods being studied, and they have come to a general explanation of that nature in US. In other markets, due to other reasons, it's different, right? Mature markets versus emerging, frontier, developing, the behavior could be different. But what I'm trying to tell you here is, I mean, you should be able to understand the shape of these yield curves, and then to explain under what circumstances the shapes are taking this pattern, right? And interpret them in line with the explanations by these theories. You don't need to tell it's expectation theory. That's not necessary, but you should know it's the explanation is in line with these theories. So that would help you understand it properly and also shape up your examination answers if any questions on this basis. Any questions? Right. Then you see the explanation in terms of what we expecting from these theories. Interest rates on different maturity bands move together over time. Explained by the first term in, you can fill the equation here. Right? So you know the equation. That's why I left this place blank to get you kind of, get acclimatized with the insights of what we discussed. First term of the equation that we discussed. It's here. Right? So similarly, yield curves tend to slope upward when short-term rates are low and to be inverted when short-term rates are high. Explained by the liquidity premium term in the first case and by a low expected average in the second case. Upward sloping L&T component, it's very clear. It's upward sloping very much on the basis of increasing L&T in the equation. But then in the second case, that is short-term rates are low and to be inverted when short-term rates are high. When short-term rates are high, future short-term rates expected to be lower. Then the average of long-term is low. So that's what this segment explains. So second requirement that explains that yield curves are upward trending when short-term rates are low. Yield curves are downward trending or inverted when short-term rates are high is explained here. Yield curves typically slope upward, explained by so-called L&T, by a large liquidity premium as the term to maturity lengthens. Term to maturity lengthens. Time to maturity become longer. You see, it explains that behavior. So this sheet is basically for you to apply some of the elements that you recognize, understood through discussion. Right. So see here, different shapes of yield curve, right? Yield curves and the market expectation of future short-term interest rates according to liquidity premium or preferred habitat theory. Here you see steep upward. Here, short-term rates are really low. And what it's expect is future short-term rates also to rise, L&T component also to be positive as the term to maturity increases, L&T component also to increase. So it makes the long-term interest rates to be really high. So the curve is steeply upward sloping. Here what you are basically seeing is mild upward. This is the general yield curve that you will see in the markets. Yes, future short-term rates and today's short-term rates are not necessarily that different. But you expect L&T component to be positive. L&T component to be positive, and it's also expand with time to maturity. So that shapes upward slope and long-term interest rates to be higher. Then you see flat. Here, you generally see today's short-term interest rates are not necessarily high, but higher than where one could argue short-term interest rates in a kind of environment where you see a steep upward sloping curve. So this entices to some extent future short-term interest rates to at least adjust somewhat lower. But this L&T component brings the additional liquidity premium to take out the declining pattern, so it makes the curve to be flat. This is the period where you probably see economies are uncertain. They don't necessarily invest. They keep things wait and see prior to elections. And if they really see elections are very tight and no clear-cut direction in terms of policy priorities, you probably see this type of a yield curve. Uncertain. But here, even after seeing future interest, short-term interest rate to be lower, liquidity premium also been adjusted with time to maturity increase in liquidity premium also increases, but still the rates are lower, long-term rates are lower. So the sloping here is downward. Here it is very much uncertain, as well as markets are reasonably confident that economy would not take off in the near term. Economy would necessarily shrink. Why the short-term interest rates have been kept higher here to fight inflation. This is high inflation point. And through high interest rates, the policymakers manage inflation to be lower going forward. So it is downward sloping. So different shapes that you are simply seeing is in financial markets, and this could be explained in terms of the yield curves and market expectations. Right. So you see here, all what we have explained here is visible across US at different point in time in their history. Right. So this is a point where yield curves are generally steep taking off, steep upward sloping horizon. But this steepness is also reflective of the slope being measured, because here interest rates are extremely low, close to zero, and then it takes off. This is immediately in the aftermath of financial crisis, subprime financial crisis in the US, where the policymakers have kept policy interest rate almost at zero flow level. Short-term interest rates are very low, and also they injected a lot of money through quantitative easing, QE programs in US. So short-term liquidity was very high. And they were having more money not being used for productive purposes in the aftermath of the financial crisis. The lenders also not ready to lend because of the difficult periods they had prior to 11s. But economy is shaping up for a higher growth trajectory with this, and it's effectively the growth was very positive from this point onwards. You have seen those with numbers. This 2006 period is prior to the collapse of financial markets. This is the point where subprime was, really pitching up. Some collapses, but generally, subprime was very much pitching up here. And US started some tightening cycle, increasing short-term interest rates. The long-term, see, it's reasonably flat. Here, 97 also, it's reasonably flat. Okay, short-term interest rates were comparatively high. From recent experience, these are high short-term interest rates in US. And during this period, they have actually, prior to 2006, the rates were very low, like 2%. And there were arguments in US that you have kept these interest rates low for too long, and as a result, unhealthy lending practices were building up. And as a result, the US started tightening interest rates to take out low quality lending out of the equation and pushing up with some inflation expectation during this period, and the interest rates started going up. And as a result, you see it's flattening. Even 97 to some extent, similar circumstances. This is prior to so-called Asian financial crisis. You had Indonesia, Thailand, Philippines. Malaysia was somewhat spared because they had introduced some controls of outflows, right? So East Asian tigers, Taiwan, they had difficulties. So with that, some tightening in US. But you see here, 1980s, 81s, here 80. Short-term interest rates almost 10%. But see, by 81, it has gone to 60. This is where US was fighting inflation. After the oil price shock-driven short-term interest rates rise. To fight inflation, then you see the curves are downward sloping. This is again mild upward sloping. It's after all these inflations and all, the gradually short-term interest rates were brought down, but long-term interest rates were marginally upward sloping. This is somewhat steep, but this is mild. So you should be able to interpret economic events and try to explain it in terms of the understanding that you generated through these discussions. That's the interpretation. That's the expectation by learning these programs. Then you see that the relevant topics that we have covered in terms of understanding, interpreting, and recognizing the behavior of interest rates. With this topic that we discussed today, we would generally close it for this particular program. So the interest rates explanations from this, you should be now able to explain it much more clearly and much more thoroughly. And if anybody further wanted to study on these things, there are programs, many programs of higher level of requirements and education. But still, you can also follow up through the textbooks and references that I have highlighted all throughout. And also generally read financial press. So that would explain you some of these elements that we discussed. So we can move on to the next topic that the handouts are shared with you all. And if you have any question, I would like to take up before I move to the other section of discussion. Right. Okay. So it's now moving again into some other interesting aspects of this program. This is the financial structure, and it's an economic analysis. We try to understand economically why financial structures are different and what the driving force behind those financial structures. And you see, a vibrant economy requires a financial system, right? That effectively kind of, takes funds from people who save to people who have productive investment opportunities. That means people who save, and those people who save would not necessarily have investment ideas, if not the projects in their mind to kind of put this money and work for their economies. But there may be some elements, some other segment in the economy, they would have these very productive project proposals in their scope, but unfortunately they don't have required resources. So what this financial system does is that facilitate the savers to invest in productive investment avenues of their savings. Okay, but interestingly, we try to understand through economic analysis, how does the financial system make sure that your hard-earned savings get channeled to a productive investment opportunity? Because there would be possibilities that your saving would end up with a unproductive or waste. You put your money in a very nice financial intermediary, and that financial intermediary led to a politically motivated, affiliated project. And ultimately, those projects would not yet bring required return for your investments. And even you might not get, if not, that financial intermediary would not get paid, but you will get paid because somehow there are other elements that we would be discussing in financial crisis going forward that would facilitate. So this section that we are trying to now study answers these questions by providing an economic analysis of how these financial structures are designed and promote so-called efficiency of these investments, and through which economic prosperity. Right. So if you look at the globe, where the financial structures and the financial systems are quite seriously evaluated and reviewed. Okay, and what you basically see from a financial structure of a business is the manner in which the business finances its activities by using external funds, which are not necessarily the capital alone. You bring capital and invest, but beyond a point, it is the requirement of the organization to generate fund external to the organization, and how you bring this. So this is reflective of the financial structure. And we look at few economic concepts that enable us to explain certain features of financial systems. Okay, where you see financial contracts are established and written and undertaken by parties to a transaction. And also, why the financial intermediaries, that means banks, other agencies, they are very important in terms of the market's financial structures than even a securities market, the bond market, equity market, where you can see these markets. But often, even in advanced economies, the financial intermediaries are much more important at times than the securities market. By looking at the share of the total finances generated by these economies, we will still see, oh, the securities market channel a less amount than the financial institutions. And it's true universally, but the effectiveness of securities market differs from the level of various other elements that we will give a little insight in this program, in this discussion. And this analysis also try to demonstrate the important link between financial system and the aggregate economy. We will not get into aggregate economy in details. That's a complete economic discussion. But for the time being, we try to kind of, see financial system and just see the paintbrush approach to see what's the aggregate economy is. Okay. Financial system is a complex in structure. You know that. It includes many different type of institutions, banks, insurance companies, mutual funds. You might not see mutual funds in Sri Lanka as such, but you see all these unit trusts. Your mutual funds are a further extension of unit trusts with much more money market approach and a wider investor segment in advanced economies, and the securities market, stock and bond markets. Okay, and these are often regulated, often by the government, if not through private arrangements through. So that's what we are focusing in this section. And then we look at this financial structure through few basic facts. Okay, so you can see here, when we look at these basic facts, we also see how financial structure designed to promote economic efficiency. You can see a chart in the next slide based on some of the OECD countries, advanced economies. You see US, Germany, Japan, Canada. Out of their total financial structure, this is for a longer duration exercise. Recent decades also they have done this exercise, but not significantly change, but some increase in terms of securities market was reflective, but effectively volumes being increased, but relative share of the bank finances, that means banks and non-banks being pulled together, have not changed much. And you can see here, US being taken into consideration. Out of the total finances it generates in the economy for the businesses, only about 1/5 being generated through banks, commercial banks. And then about 2/5, about 40% comes from non-banks. So these two together, about 55% is coming from financial intermediaries. And the bond markets and stock markets together in US, it's about 2/5, about 40%, effectively 43%. But you can see here, the Canada, the banks are the biggest financiers compared to non-banks, but some distribution in terms of bonds and stock markets. But looking at Japan and Germany, almost 80%. Almost 80% of the economy's finances being generated through the banking sources. The financial intermediary is bank driven in those economies. And non-banks also taken into equation. See, 76 plus 10, 86. 78 plus 8, again 86. So only less than 15% is contributed by bond and equity markets in Japan and Germany. And there, the financial intermediaries are so significant than what you see in terms of financial intermediaries' role in US and Canada. But still, US and Canada's financial intermediaries' role is also significant because it's more than half. The stock and bond markets remain active in US and Canada, right? But in Japan and Germany, of course, they are active and complex and sophisticated compared to some of our experiences, but the significance of their financial system is very much with the banking sector. So that's why when I was explaining here, I just highlighted the fact that why financial intermediaries are more important than securities market in financial systems. You have to give significant importance to these financial intermediaries. So you have got a kind of a feel about what type of finances dominate in these economies. What type of finances dominate in small economies like Sri Lanka? Effectively, the banks leading in Sri Lanka too. Non-banks also contribute. And bonds and equity markets, yes, it's there, but in Sri Lanka's private sector bond market is very small, very insignificant. The government's bond market is quite significant, and government's finances, more than half of being channeled through the government bond market. So these elements will give you some comparison in terms of how these different economies sourcing their funds for businesses. And we can move on. And the facts that we are trying to understand to recognize the financial structure is these. And we look at 8 basic facts in this exercise. Any questions before I move on? Right. So you see these basic facts. So one fact of these financial structures is, now you know, despite the big hahoo, stocks are not the most important source of external financing for businesses. And you have seen it is financial intermediaries. Stocks are important, no argument with that. It's actually expanding. But then, of course, the financial intermediaries financing also expanding with some more complexity, some more new arrangements, new structures. Yes. So the first fact is stocks are not the most important source of financing, external financing. When I say financing, for businesses. And then issuing marketable debt and equities, bonds and equities, is not the primary way in which businesses finance their operation. That's another fact. By issuing bonds or equities is not the primary main way in which businesses finance their operations. There are major other ways through which the businesses finance. Maybe a bank loan. There are other internal finances also, like retained profits, retained earnings. There are ways through which the businesses finance their operations. Then indirect finance. What is indirect? Is many times more important than direct finance. What is direct and indirect? Now already you know, we have looked at the country experiences in terms of what structure dominates in those economies. So what do you mean by indirect is a financial intermediary driven finances, external finances to your business. The banks, non-banks, if that is the dominant force, the economy is indirect finance driven. And Germany and Japan is heavily financial intermediary driven and favors an indirect financial structure. So if anybody asks you what is the financial structure of Japan and Germany, you can very easily say it is indirect finance driven. Whereas direct finance driven means the equity bond based. So you are directly going to the market and raise your funds. So you basically create owners by issuing equities. Whoever invests in equities, they become owners of the business. Whoever buys bonds, they are not necessarily owners, but they have significant influence or rights in terms of the business's resources, the priority in servicing. And you source funds from indirect financial intermediaries. It's a contractual relationship. But interestingly, in Japan and Germany, you read through their financial structures, you would recognize the fact that the agencies in those countries, the financial intermediaries, are often play a very, very significant role in business expansions and business financing process. And they are keeping significant surveillance, monitoring, evaluation, reviews, and through which the financing lines that they have extended to these businesses significantly depends. So you have to recognize indirect finance, even in US and Canada's case also, pulling together banks and non-banks together, still it plays a very significant role than direct finance. And then the fourth fact, financial intermediaries, particularly banks, are the most important source of external funds used to finance businesses. You have seen that. from the empirical evidence we discussed. So the banks play a very important role. Financial intermediaries play a very important role, and that is the most significant external source of finance for businesses. Right. So what's the next fact? Then another interesting element of these financial systems is the financial systems in any country, in any economy, are mostly regulated. It's one of the heavily regulated sectors because we channel, financial systems channel funds from all the parties to so-called productive investment propositions. You don't know to whom your fund is channeled. You have a contractual obligation with the agency, financial intermediary with whom you have maintained your savings or investments. Those agencies have another contractual arrangements with the parties to whom they lend out, or they invest in bonds or equities. So the process through which the savers' money, savers' resources has to be looked after by a third eye regulator. Because the intermediary and the user, the borrower, would not necessarily putting his own resources into that process. It is somebody else's, third party's money. So somebody else has to regulate with systems and global arrangements, because it's a financial system now linked across the boundaries. It's not limited to your country's borders. No, there is no borders for financial systems now. It's interlinked, and your payments are everywhere. You can buy things, you can send money, you can get things, you can receive money, you can channel resources from one party to the other. You not even know who the person with whom that you are transacting. It is only you are aware of the process through which that you are transacting. That makes you simple and easy, as long as everybody honors the established process. If somebody breaks the process, then everything becomes complex, and you require the policing. That's the regulation to some extent. So the regulation is one of the very important fact in the financial systems in today's context. Self-regulation is another element within that. We will get into those stuff as we move on. And then the other element, other fact is, although the securities and bond markets are well established, generally large, well-established corporations have easy access to these markets. Why? These large, well-established organizations have all the arms. They have securities arm, they have marketing arms, they have custodian arms, they have legal arm. Everything is there, right? So when they require finances, they can easily promote the finances to the general public, general masses, and get those investments. But a small timer, nobody knows them in the first place, and even trying to promote them would require substantial resources to be spent. And then, of course, the processes through which you have to go through, documentation, legal and other complex processes, it's time consuming and requires substantial expertise and resources. So all is there. So it's natural to say another fact is that the big and well-established organizations have easy access to securities markets. Then the other element is collateral, is the main component of debt contracts. You can borrow, you can finance, but you have to actually keep part of some of the assets or some of your resources as collateral. And particularly for small timers, it's like a must. No financial intermediary would lend you just because you have a wonderful business idea. That's why venture capital and other elements are coming into play. Support from government and other agencies. But generally, financial intermediaries would try their best to reduce the risk by taking a risk-averse position by asking a collateral. And the other eighth fact is debt contracts are complex. It's very difficult if you are not familiar with some of these contractual obligations and documentation and legal processes involved. And then there's this restrictive covenants. You can't do certain type of activities once you engage in a financial borrowing like that. That's to have either CSR related or, for that matter, risk related. So these are the elements which makes the financing and the financial structures a unique and very important in today's context to understand in determining what type of financial structure is actually contributing and actually fashioning your economic efficiency. And there is no one-size-fits answer here. It might be direct or it might be indirect, but it's a complex process through which economies are expanding. So any questions? So this is a good point for me to stop, because transaction cost, economies of scale, adverse selection, these are other very important element of financial structures, financial systems that we have to deliberate and understand. So I can start from that point in our next discussion. If you have any questions, I can now take up. If not, we can stop the discussion at this point.